What's going on, guys? Welcome back. So chances are, if you're watching this video, you're looking to invest your first $1,000 into the stock market. Now, obviously, I'm not going to lecture you in the fact that the stock market and putting your first, say $1,000 in the stock market is one of the best financial decisions you can make. However, it does come with a lot of risk. So obviously, anybody can tell you, and this is just going to be a full disclaimer about it, is that stocks are risky. That's the reason why people get a return on their money, is because there's a risk premium that they're willing to pay for in order to, say, get that payout. Now, I am no financial advisor, and I cannot say whether or not you should particularly be investing your money in the stock market. However, if you have already decided of your own accord, or if you've been advised by your financial advisor that you should be putting your money in the stock market, I'm going to be going over what I did when I only had, say, $1,000, and I wasn't really, making a lot of money. I didn't have a lot of options out there. I'm going to go over what I did when I first started, and then I'm also going to go over what has changed in that landscape, so, say in the 5 years, whatever, that I've been investing, and what are the tools that I see now that I would really be taking advantage of if I was, starting all over again and only had $1,000 to invest, and I was completely new to the entire investing landscape. So if you guys are interested in that, make sure to hit that like button, hit the subscribe button, and stick around to the end of the video when I give a couple of comments about, what my overall thoughts are on, looking back at everything that I've done, and then also any different recommendations I can make for you guys to look into for your investment journey. So if you guys are interested in that, make sure to hit that like button, hit that subscribe button, and without further ado, let's get in the video. Alright, so chances are, if you are investing your first $1,000 in the stock market, you're generally in two camps. You're generally someone that is very old and, you've been kind of terrified of the stock market, or you have, been living paycheck to paycheck for a very long time, and you finally got that promotion, or you finally cut your expenses, and the fact that you're able to bank some money, at the end of the month, and then you want to invest that money and grow it. And then you also have the people that are very young and really don't have a lot of money, but they really want to start their money to grow, and they really understand, like, okay, if I want financial freedom, say by the time I'm 45 or by the time I'm 60, I need to have my money put to work immediately, so that way my money can make myself more money. Those two different school of thoughts have very different approaches to investing your money, especially your first amount of money into the stock market. And I'm going to be focusing on the younger crowd because that is the people that I feel like I have most relevance to. Now, obviously, if you're older, some of this will still pertain to you and that you can look into, but I'm a college student. I'm just graduating now. And, I know what it's like to be dirt poor and trying to invest to make my money grow for me. So that is the group of people I want to be talking to, because I can completely relate to what type of situation you're going into. And I want to share what I did with my journey, and then I also want to talk about what I would change about my own past if I were to do it all over again. All right, and so now we know who exactly I'm talking to and what I want to explain. If I was, say 18 and I had $1,000 to invest and I really wanted to, really get my money to work for me, essentially what you need to do, in my opinion, is that you need to come up with a game plan of what exactly you want to be doing with that money. Now, what does that mean? So obviously, there are many different types of fish in the stock market. You have people that are day traders, you have people that are swing traders, you have people that are intermediate traders, you have people that trade on news, people that speculate, and then long-term investors, and anything else that can fall under any of those categories. So you really need to figure out what direction do you want to start in, because I can almost guarantee you that you're going to pick, say, very long-term investor or a day trader or something like that, and it is going to change. Something about your personality is going to not jive that well with that individual investing style, and investing in a way that doesn't commingle with your personality is one of the most difficult things that you can go through, especially when you're watching and trying to manage your own money. And trying to be the type of trader you're not. So say, for example, if you really want to become a day trader and you go into it and you can't handle stress that well, that is probably one of the worst options that you can do in terms of trying to make your money grow for you, because you're going to be making really irrational decisions on the fly, and you're going to see your account just go negative day after day rather than actually turning you a profit. Same thing is that, say, if you go in and you're like, I want to be like Warren Buffett, I want to be a long-term investor. But, if you invest in a company that you expected to hold on for, the next 10, 20 years, and they come out with one bad earnings report and the stock drops 20%, you are freaking the hell out and you just want to be sold out of the company, chances are you're not going to be that successful of a long-term investor. So you definitely have to really figure out, what direction do I expect to be going into? And then after a couple of months or even a couple of years in the market, you really need to reflect on yourself and decide, okay, this is what I wanted to do going in, and then this is how I act during it. Do I either need to do one of two things? I either need to, one, create systems that don't allow me to do the type of impulse decisions I want to do, or I need to reevaluate how I'm approaching investments, and then I need to restructure that to, jive better with my individual personality. So that's something you definitely need to do, because at the end of the day, if you don't want to be, focused on managing your money, and you don't want to be, actively investing and actively picking stocks, there's really no reason why you should be actively picking stocks in the first place, because in order to do it successfully, you need to commit a lot of time to it. And if it's something that just isn't jiving with you, you're not going to be putting in the work, and you're essentially just going to be gambling at the end of the day. And if you fall into this category, I would highly recommend, if you are looking into, you want exposure to stocks and equities, definitely look into, say, the more passive investor, going into individual ETFs. You can look at Warren Buffett, and Warren Buffett recommends that the average individual should just be dollar cost averaging the S&P, because at the end of the day, unless you're willing to put in an extensive amount of homework and, have a really strong grasp on your emotions and also your risk tolerance, you are not probably going to outperform the market over the long run. So that's something you can definitely, do, set aside, automate it, forget about it, and you will still outperform over 90% of people that spend 40 plus hours a week trying to figure out what is the best investment. Now, so stepping aside from the mentality aspect of it, which is probably one of the biggest parts of the stock market, I should remind you, is psychology, focus in on more of like the nitty gritty and like the tools you're going to be needing, is that you're going to need money and you're going to need a broker. Now, if you are someone that is extremely young, or, you don't really have a lot of excess capital, I would highly recommend looking into robo-brokers. Now, two examples of that could be Robinhood and M1 Finance. These are two of the brokers that I've used and currently use, and I have, some mixed reviews with them depending on different situations, but all in all, I do think that for the convenience of not having to pay a commission, they are hands down worth it for, the little headaches they have to do, especially with trying to deal with their customer service. I personally found for myself that it was totally worth it to, have to deal with a bunch of stupid automated emails in order to not have to pay any transactions whenever I go to make a trade. If you, for example, like if you go and open up an account with Fidelity or any other of the mega large asset managers, you're going to be looking at anywhere between, a few dollars to $10 a trade. And, if you're only investing, say, $1,000 into it, you're losing 1% of your money right off the buy, and then you're losing another % of your principal right off the sell. So essentially, in order to break even, you have to be making 2% of your money. And that's something not a lot of people pay attention to. And especially if you're young and your income's going to be growing, and you're only going to be able to throw, say, $100 or so at a time, throwing in $100 and then losing, $5 off of it, and you just immediately lost 5% of what you were going to buy. That takes a long time to recover, especially if you're in, relatively stable, undervalued assets. It's not like you're trying to go in and out really quickly. You're expected to, kind of ride out that, that return. But all in all, if you're going to be taking a 5% clip off of every time you go to invest, a lot of your wealth is going to go away, and it might actually be better just putting it in a high yield savings account. So I would definitely recommend looking into a non-commission broker that you trust, and that, you kind of look into the reviews about it and you figure out, okay, how does it work? How quick is it? How responsive is it? How's their customer service? All of that stuff. I definitely would say heavily look into that. You can go with a traditional broker account like Fidelity. However, definitely keep in mind the amount of money you're going to be spending in commissions whenever you try to make your trades. Now, personally, I am switching most of the new money that I'm deploying in the stock market into M1 Finance. And that's largely due to the fact that I am a longer term investor. I'm not going to say I'm a buy and hold until I die type of investor, but I am an investor that I plan on putting my money into these companies and then riding it out for multiple years. And then eventually I may or may not take my money out of it because of that. Now, M1 Finance, such as Robinhood, again, it doesn't charge you a fee, but M1 Finance allows you to buy fractional shares. What that means is, say if you only have $1,000, you can put say $300 into Amazon, $100 into Microsoft, $20 into Nike, and spread out your money without a limitation of what different types of assets you can actually hold. And that's one of the reasons why I really like M1 Finance, is because when you structure your portfolio and you decide this is the allocation I would have if I say had $1 million and I could afford as many shares of any company I want, M1 Finance allows you to do that. The only real drawback to it is that you need to do a minimum of a $10 transaction, and whenever you go to place an order in M1 Finance, it generally takes to about 12 a.m. here on the East Coast in order for that trade to actually execute. So say if I want to buy $10 of Starbucks, I put in the trade, say 10 a.m. on Monday. That trade isn't going to execute normally until 11 a.m. on Tuesday. So that's something you definitely need to keep in mind. Personally, because I don't really care about, like if I get an extra 1% or pay a less, like if I save 1% or gain 1% depending on the day, I don't really care because I'm looking at, let's say, a couple of year time frame. The way I look at it, because I'm not trying to time the market, to that level of a degree, depending on if I get the stock and it's up or down, it's going to be like flipping a coin. So I really don't care. What I focus on is the fact that I can allocate my portfolio the way I want and I can buy fractional shares. All right, and so now you have the mentality down and you also have the tool that you're going to be choosing to use in order to execute all your trades. So now what do you put your money into? And that is going to really tie into your psychology and your individual, mentality towards investing. You think investing is all a gamble? Are you just doing it to test the waters? Or have you put a lot of research into it? You've done a lot of work and now you're like, okay, I think I'm fairly good at picking a stock. I want to throw my money towards it. Now, again, obviously, I'm not going to be recommending to you what you put your money into. However, I'm going to be recommending what I did and what has worked out for me. So what I do is I prescribe very closely to the Peter Lynch mentality. Peter Lynch focuses on a couple of things: growth, value, which generally don't go hand in hand, and then also investing in what you know. And then diversifying among what is growing quickly, is trading at a good value, and you don't want to have all your eggs in one basket, but at the same time, if you really know 5 stocks, but you need, say, exposure to the oil space, so you throw your money into the best looking at a surface level oil company and you start putting your money in a 6th stock, that is what they call diversification, which means that you're essentially gambling with that portion of your money. And even though these stocks are concentrated, you'd probably be better off just sitting your money in concentrated stocks that you know very well. So what I personally do and what I have been doing over the past is I generally try to keep my individual stock portfolio around anywhere between 5 and 15 companies that I know really well. And when I say really well, everybody has their own opinion on how long they want to research a company before they invest in it. But I will say, before ever I go very long in a company, if I do a swing trade here or there, which I do and I document on the channel, that only takes a couple of weeks to a couple of months of research. But if I'm looking into a company that I want to hold on to my money for, say, 5+ years, I will do anywhere between 1 and 6 months worth of research to really focus in on that company, figure out what direction is this company going in, how accurate and how trustworthy has management been over the long term. And by that, I mean looking at all the 10Ks, all the 10Qs, figuring out how they're competing against, their ever-changing, competitive landscape. And then also, what are they really doing to prop themselves up for the future? Or are they really just trying to maximize shareholder return in the short term? And then, what's, the next CEO's problem is the next CEO's problem. And they don't really care about their shareholders 10 years from now. They care about their shareholders 2 weeks from now. That is the type of environment I want to be in if I'm holding my money with a company long term. Because essentially, I want to be able to be like, I own this business and this business is going to produce me money. I'm not going to be throwing my money at a little symbol that has letters and numbers in it and expect it to make me money in the future. No, I'm going to be buying a portion of a company that I either love as a consumer, love as a business owner, preferably both, and I know for a fact how that business is going to probably perform over the long term. And so now, while I have in the past carried a very concentrated portfolio, I will say that the level of concentration that my portfolio has isn't depicted on a special number I have of how many stocks I want to have. It really depends based off of what I do to do analysis on a company, the type of return I expect to be getting out of it, and then just how many of those I can find. So I think the most important thing, regardless of how many stocks you invest in, is you have to understand why you own it, and then what is your expected return, and why do you expect that return. So wrapping that all up and kind of wrapping up this whole video is that at the end of the day, there's going to be no right answer for how you should invest your money or what you should do with your money. No one can answer that other than you. And you're going to hope that you make the right answer, but because you don't have experience yet, you're going to try to latch onto someone that it's worked out for them and then try to copy it, which is fine. But at the end of the day, there is no, template for getting, you follow this rubric and you put your money in a stock and it makes you money guaranteed. That does not exist in the world. You always have to have a different perception of it. You have to be doing more homework than the guy next to you. And you also have to have a better control over your emotions than the guy next to you. Otherwise, you're going to get eaten alive. So, with that being said, this was kind of a rough layout of everything that I think you need to have in mind before you start throwing your money into to the stock market, and things that I wish I focused on more so when I just started out. So hopefully you guys got some use out of it. Let me know what you guys think in the comment section down below. For those of you that are older investors and just kind of stuck around to the end of the video, what recommendations do you give people that are just starting out in the stock market? And what were the kind of the things that, looking back on it, you wish you could change about your investment journey? So thank you guys again for watching, and I'll catch you guys in the next video. Peace.